All right. Here we go. With that said, thanks for having us, Capital and Endowment Campaigns. And we will get started here. So we'll walk through a quick intro into Armanino. We'll walk through promises. And I think what you guys are all really wanting to see and some insight that we can provide is some of the top 10 capital campaign reporting errors that we don't want you to commit. We're auditors, and we don't want to have any kind of adjusting journal entries when you guys do your capital campaign. So we'll provide some insight there. All right, my name's Dean, and that's a really big picture.
It's a lot of
been in private schools for over 17 years. I've been speaking for NBOA for a while. Jason.
So give me a minute. I'm trying to catch my breath. I had to run back to my room to grab my computer. So
I think Jason's room was in Memphis. It was so far.
I'm dying. Anyway, so Jason Gilbert, happy to be here. Partnered with Armanino. I've been with Armanino just over 10 years. Move this down. And heavily involved in the school practice area. We as a firm take pride in how much we do with private schools, and Dean will jump into that real quick.
Yeah, we work with over 170 private schools, I think, in over 6 or 7 states, over 650 nonprofits, primarily out of California, but schools in Florida, Dallas, Chicago area as well. We do work with numerous schools. I think everybody's familiar with the niche.com. If you look at some of those schools, we do work with numerous schools in the top 100. So it's kind of what we do. You might have saw Jason and I at the Business Officer Institute. If you went to La Jolla, we spoke there about contributions receivable. And that was a group that everybody was 1 to 3 years, so they didn't have the experience that you did. So we got like 5 slides in and we basically gave up and just said, let's just answer questions. The annual meeting, we've spoken here every year. And you could have seen us on the contribution, or me, on the contribution webinar series with Jennifer Hillen as well. We do a lot with the MBOA, and we're very proud to be a partner. All right, so let's get to it. We all know that this matters because of the fiduciary responsibility of you and your board. Let's face it, when we come in and we do that audit committee presentation or we do that finance committee presentation and they say, who are you? And I say, we're the auditors. And that board member looks at me and goes, okay, is it all there? Is everything okay? That's what they want to know, right? They need that stamp. They need to know that everything's okay. And we all need to work together to make sure that that happens. Okay, so what is a promise to give? We know that it's an agreement to contribute in the future, whether written or oral. We will talk about documentation. The reason that this is so interesting is because this is a one-sided transaction, right? I'm going to give you something for basically a piece of paper that says that I gave a donation. And let's face it, are you really going to come through? Our largest private school client for the longest time, they took a qualified opinion because they wouldn't record these things. They're like, we'll record it when the cash comes in the door. That was our largest private school client. So we do have schools with that type of mentality, but we definitely want to do this the right way. So here we go. Jason, let's talk about written promises and what you're looking for here.
So a lot of times, as long as we have some sort of documentation that says the donor said okay, right? They've committed to that dollar amount and they've given a time schedule of when they plan to make that payment. Obviously, it's great if it's in a pledge card and it's clean and we can go, okay, here's the date, this is when it was given, this is a future payment schedule, and this is when they plan to, fulfill the pledge. Or, an email. If you have a long-term history with the donor, right, and they have a history of giving to you, right, we can get to less. But as long as we have something saying, hey, this is what we're giving and this is when it's going to happen, that's usually good enough for us.
Okay. Who here? Okay, real quick. Is there any development people in the room? Oh, yeah. There's no one, right? I'm making sure before I get myself in trouble. All right, so this is a safe zone. Safe zone. We're all safe here because we're talking about verbal promises. I want to know who in this room records. Yeah? Who in here? We all know that we have competing biases, right? We're conservative. They're aggressive. They're going to record everything. Everything. So how does anyone in here record verbal promises? Oh, I love it.
What we do with
Oh, hold on. 1 second.
yes, if there's confirmation, it isn't just I met such and so at an event and they said they'd give me $10,000 and we follow up. Thank you. Great to see you at that event and thank you for your $10,000.
I love it. So you touched on a couple things with regards to, I apologize, with regards to verbal promises. That follow-up written confirmation and that history of payments, right? I think the thing to know here is to also be tracking these. We do have a school that they don't record them, but they had in their campaign, they had $5 million of oral gifts that we said, okay, if you don't want to record it, why? And some of those had long histories of payment, but that was a disclosure in their financial statements that they did have $5 million of outstanding gifts. Jason, any thoughts here?
Yeah, the thing is, technically you should record them, right? That's.
Mom's just going. Technically, we should be recording them.
Technically, yeah.
And the development person says, "I'm not recording it." That's, as y'all know, that's the way it works. They keep up with them on a spreadsheet, right? And when I'm doing stuff for the board, I have to say, "Okay, what about here's the stuff from Black Hawk? Where is the oral pledges?"
Right.
And they give me a spreadsheet. And they never want them, they will not put them in the system.
Development will not.
Development
Whoa.
will not put them in the system.
That's not normal.
So, wow.
They don't want, that audit letter going out. They just, we're all good friends here. We don't
Yes.
want, we don't want it recorded. And so at what point can you say, really, they need to be recorded?
Jason.
So I'd say in the case that you have a donor that is fulfilled on other verbals, right? They have a history of making the verbal and then within the year or 2 years making good on it. I would say when they make the next verbal, you have pretty good evidence to say we should be recording it and it should be on our books and records and tracked. The other thing is that if it's one of those where there is some other form of confirmation, right? Because sometimes they'll do the verbal, but there is, and they may not be showing it, but I bet there's some sort of dialogue behind the scenes that you could get to that would support it. I would say at that point you should be recording it too.
Right.
Does it really make a difference to the auditors?
No, it does.
It does.
What's
We want to see the history. I want to see a long history of them coming through on oral pledges. And if there's a donor out there who's very reluctant, they say, hey, I'm going to give you $100,000, and that's at the gala or whatever. And then maybe they do that every year and they give a check and you feel good with it. But the second that you start to have email confirmation and you start to say, hey, so when are you going to give that $100,000? And you start to answer, start to ask those questions and they become reluctant to give you those answers. Now we're starting to not feel so good as an auditor. Right, but if it's a free-flowing conversation and they're willing to give details and give some transparency, then it feels better. So there is going to have to be some judgment here.
So I have a question. So we've never done a capital campaign. We may embark on a capital campaign. We have no history of major gifts. So we have no history of major gifts, and we're looking for 6-7-figure gifts for a major capital campaign. So my assumption is, without a signed pledge agreement that's defensible, I'm without a history of giving, I'm not going to record anything until I get that. Would you agree?
So,
Go ahead, Jason.
So I would say, first, get the pledge card, right? And if you don't get the pledge card, to the extent that you get a verbal that says that they're going to make payments over the next 2 years at $500,000 a piece, right? And they make the first one, I would say that you should be recording the second one.
And the interesting thing is that your auditor is right there. Okay, what about wills, Jason? Do we record these?
Yeah, well, depends. That depends. A lot of it depends on the way that the will is written. If it's a revocable, right? So at some point, somebody could come along the way and decide, you know what, we're going to change this up and we're not going to give to the school. That should not be recorded. If it's irrevocable, an irrevocable trust should be recorded.
And especially if the person has passed away.
Yes.
I had a school one time that it was a small school, $4 million balance sheet. And just so happened that an alumni of that school was one of our interns. And she said, "Oh, Dean, isn't it great? You're doing the audit for my school. You know, they got that huge gift." And I'm like, "Well, what do you define huge?" She's like, "I think it was like millions of dollars." And I'm like, "The balance sheet's $4 million. I'm a senior auditor, just confused." So I go into the CFO's office and I'm like, "I heard that you guys might have had some big gift." She's like, "Oh, well, this person died. They named us in their will. The family's disputing it. The kids don't want it to happen. So we didn't feel like we should record it." I go, "Okay, well, cool. Can you send us the agreement? Can we look at that, the will? And what do you think? How much is it being valued at? Things of that nature." It was the third largest gift ever given to a private school, a Catholic school in the nation. $16 million endowment. She was like, "Yeah, we're not going to record it yet," because I was like, "That person passed away. Like, you're in the will. It says everything's come to you." And she was like, "I don't feel comfortable recording it." I was like, "Well, I don't feel comfortable as your auditor." Okay, so it does depend, and we'll have to work through all of that. All right, conditional versus unconditional. This is another a place where we do find errors here is, if it's an unconditional gift, you do record it now. And if it's conditional, we have to make sure that those conditions are met, and we'll walk through those now. So Jason, walk us through some donor-imposed conditions.
So if the donor's asking for something, right, that you complete a phase, or there's some sort of, stage component to you getting to the rest of the gift, then there's a condition there. So I would only record the first portion that is, hey, I'm giving you $50,000 now. Once you guys complete the development or break ground on the building, then I'll give you the remainder. Well, I'd only record the 50 until you actually break ground.
And then what about challenge grants are very popular these days with donors who feel like, they want the community to step up, right? We all know that as private schools, we might have one or two lead donors, and they want the community to get active. So we see a lot of challenge grants. Talk to us a little bit about that.
So the challenge grants are interesting only because you gotta be very careful with the way it's written, right? And a lot of times those span multiple years. And it could be a cumulative effect, or it could be as simple as they say, hey, if you get to $1 million, I'll match the $1 million. Well, what happens if you don't get to the $1 million, right? What if you get to 800,000? Will they give you 800,000, right? That's all stuff that you got to make sure is in the contract or stipulated between the groups, and the parties are on the same page of, hey, here we are. Now, if this donor has a history of making good on challenge grants no matter what is fulfilled, I would say you record it once you get to that number. So if you get to 800, you'll record the other 800 from that donor. If they don't have a history, this is your first time through it, and you don't know whether they're going to fulfill it, I wouldn't record the 800 from them yet.
And this is best practice up front. What we would like to see you do is have that conversation with your advancement director and your head of school as this is being designed, so that you are out ahead of it, so that so that you have some control to say, operationally, this is how we're going to have to account for these things if we don't get some transparency through the process.
So if they give the money, so they write a check and say, but this is a challenge grant for a matching grant, which we have had. And so I'm just asking what the process is for that. We recorded it and waited to year end to see if we got the match, and we did, so it didn't become a problem. But it's tricky.
So if you end up in a situation where you end up with a donor that gives you the money up front, but there is a challenge or a condition tied to it, until that condition is met, that's actually a liability.
Right.
It should not be revenue. So you should be booking it as a liability because there's a potential, and hopefully they wouldn't do this, but there's a potential they can ask for it back.
And that is the way we report it.
Yeah, that's the right answer. And I think what you're hearing is, because that always happens as auditors. What we don't like to do is come in, we're doing the audit, Bill, and we go, what are these other liabilities? What are these other assets? Like, what are these new things? And it's those gifts that have come in throughout the year that people don't exactly know what to do with. Reach out to your auditor right when it's happening, right? Because we don't want to see that big number sitting there going, what is that? Is that going to have to be an AJE? What's going on? So, question.
Well, this is along those same lines. We had a gift, a fairly large gift that was given to us in the form of a challenge. We have it, we report it as a restricted gift. It's restricted as to, time and conditions. Why is that not okay?
So the difference there, and we're getting a little heavy here, but so bear with me. So the difference there is that you do have a restriction. So a restriction, say there's no challenge or there's no step, right? So you have a restriction, you're going to book it because you got to meet some condition, but that condition isn't, how can I say this without, so the condition is considered remote, but I'm trying to do it in a way that was going to be cleaner for the group so I don't confuse everybody. So in the case of a challenge grant, if the condition is something that is not likely to be met, right, that you don't foresee that you're going to get to whatever they're asking for, right, at that point it shouldn't be recorded as revenue, so it'll never end up in your restricted net assets bucket because it'll still sit on the balance sheet and it's never revenue. It'll only be revenue if you know that you're going to meet those restrictions, right? So if you know you're going to meet those restrictions, you can book it as revenue and hold it in temp until those other conditions are met and then release it. Yeah, right.
There are things, though, that, some foundations will give grants to a capital campaign, and they'll put a bunch of administrative requirements on there. Is that considered a condition?
So,
like,
yes.
If you finish the building, are you going to get permits? Are you going to do this?
So those are conditions, right? But the chances that you're not going to go and fulfill those conditions are really slim. So at that point, I would record the revenue and book it in your restricted net assets until you actually fulfill those processes along the line.
Great. Let's see, condition. So we've talked about recognizing revenue in stages. Yeah, the governmental grants. Let's see, transfer of assets. Oh, here we go. Look at you. You jumped ahead. You're so good.
Beat us to the punch.
Yep. The refundable advance, that does happen. We do have schools that receive the cash and get the promise, and that is a liability, as we talked about. Okay. All right, Jason, this is stuff that is going to be changing. We know that there is a new FASB reporting accounting rule up there, so this will change. But currently, Jason, let's talk about this.
So currently, in the way we left it as is because we didn't want to, make this more confusing. But as it stands now, this is what we're dealing with: is we have permanently restricted and temporarily restricted. Permanently restricted, as most of you know, are the corpus gifts that you can't touch. Right, long-term gifts from the donors that you get the earnings off of, but you can't touch those actual corpus gifts. Temp restricted or purpose or time restricted. So it's either written, it's some sort of capital campaign, or long-term annual fund giving where it's implied. Right, you don't have the money yet, so you can't release that gift until the money is actually received in your hand. And then what else we got? These type gifts, right, permanently restricted, temporarily restricted, are only donor imposed, right? So this isn't something that the board's coming in and saying, hey, we're going to set aside these funds and put them in this special bucket. Those don't end up in your temp restricted, perm restricted. That's board designated, but it's still considered unrestricted gifts.
And we can actually, quick question.
Where you describe implied long-term annual fund, can you help me with that? Because we're actually embarking on a campaign that's going to be a comprehensive campaign, which means they're going to ask for the capital gift and the annual fund gifts for the next 4 years. So can you just elaborate on that a little bit?
So what we're saying here, so say you're getting annual fund gifts over 4 years, right? Somebody comes in and commits $400,000 over 4 years, meaning they're going to make a $100,000 payment each of the years. They make the initial pledge, and that first year, right, they only make $100,000. The remaining $300,000 hasn't been received. Because you don't have the cash in hand, it's a temp restricted gift. It's time restricted. So they didn't impose any restriction outside the fact that you don't have the money yet. But since you don't have the money yet, you can't record it as unrestricted because you can't use those funds. Those funds aren't available. So you have to record it as, you're going to have to move it out of unrestricted to temp.
So to ask a follow-up question then?
Yeah.
Discount the value of that remainder, the $300,000 in your example?
So you will have to take the payments. So the question was, do we have to discount the following 3 years? Sure. You will have to discount the following 3 years.
Is there any way around that?
So
In the audit world, it's called materiality.
So it's all in a matter of how big is that number, right? So I think you're going to have to go through the process of calculating how big is our discount, and is it significant enough that we need to place it on the balance sheet and record that discount. Now, if you do the calculation and it's minimal, I'd argue you could probably get away with not doing it.
The other, I love the nitty gritty of it all. And with annual fund, it's, because you said, when you receive the cash, you can release it. It's when the due date passes that you can release it, because only the donor can restrict it as to time. And just little stuff like that, you know, like, oh, when do I release it? When do I not release it? Or even with the...
And hopefully it's in that year.
Yes, hopefully, but you know, we have things that stretch out for 5 years and then suddenly it's taking 8 years, and I'm like, no, we still track it. He's got to release it, and that's helpful. And why would you care? Is because it can help with your liquidity covenants. So it's stuff to think about.
And so we've actually touched on 3 things that are all going to be in the new FASB, which I will get to right after this question.
Hi. Back to Rose's point. So what rate do you recommend or suggest that we use when we discount?
So normally, here's the approach that we've taken. We use a blended rate. This is what we recommend to all of our clients, that we use a blended rate of your expected return. So whether you have an endowment or not, your expected return on the endowment or your expected release from the endowment is, say, 5%. Then we combine that with the treasury bill rate. So say it's a 5-year pledge agreement, you're going to take the 5-year note and take the blended of the two as your average and take that as your discount. And that's what we've found to be more prudent. The reason we do that is because as we get to other slides, we talk about allowance, right? And we're already looking at setting aside allowances for gifts or pledges that may not come in. So you're removing part of the risk, right? So you wouldn't come in here and just take the full-on, expected return on those monies, right? The 5%. So we're discounting it back because you've already taken out some of the risk.
And so we do have everybody knows we do have a new FASB nonprofit reporting guidance coming out. And there was a couple topics that we touched on briefly. Do you have another question? Follow on? No? Okay. So we touched on this is going to be called in the next FASB, this is going to be called with restriction and without restriction. They're no longer going to be called permanently restricted and temporarily restricted. We also talked about the liquidity footnote. That's probably one of the biggest things that is going to have a big impact. And we think specifically to private schools. We work with a lot of private schools, and there are some private schools out there that if you're a board member and you read those financials and you're coming from a for-profit world and you see, let's just say, $15 million in cash, $8 million in receivables, and another 30 or 40 in investments, You're like, all right, I'm a board member here, and this feels pretty good. And you don't realize when that school has a really large endowment that liquidity is tight. And if their investments are maybe in level 3 type investments or investments that are hard to liquidate, it becomes very challenging. And you might have a lot of assets and might not have any liquidity. So I would tell you all now, if you are planning that capital campaign, to get ahead of this liquidity footnote and look at your investment strategy, look at all of these things and say, hey, what is our liquidity story that we're going to be putting in our financial statements as we go out and raise money? Because I do know of a school, I can think of a couple schools, and excuse me for this term, but we call them trust fund babies, right? They have a huge endowments that they live off of, but they don't generate much cash flow. They don't really have much liquidity. They don't really have much flexibility. This is an area that you really want to think about as you go out and your financial statements will be used. Okay, so let's see here. Oh, contributions, implied time, we just went over that. Contributions of long-lived assets. Jason, do you want to touch on that briefly?
Yeah, so what we're talking about here is whether they should be recorded as permanently restricted.
Yeah.
Part of your endowment.
Some people, some families will say, hey, we want to gift a building to your endowment, which is kind of an oxymoron, right, Jason? Right? A building by its nature should depreciate, but an endowment is supposed to stay in perpetuity.
Right. So what do you do there, right? So that they're saying they're all about claiming it's an endowment gift, and you're like, well, I can't touch in the structure and the meaning of endowment. You can't touch the corpus, right? So, but you know that thing's going to depreciate, and just if you don't touch it, it's going to wither away to nothing, right? And the value's going to go to zero, right? You're going to have to replace it. So those long-lived assets, they can name it, right? They can call it, but it's not an endowment.
Great. And what about the release? How is that going to happen on long-lived assets?
So if they're giving towards a gift, right? So it's a gift, and it's actual your new construction, right? In this case is what we're really implying here is that upon the completion, expire over the expected life, you can spread it out. All this is actually changing, right? So the new pronouncements and the new standards are going to change all this stuff. This is what's happening now. Now, the latest accounting bulletin says that we can release it as it's incurred, which I'm super excited about. Because in the old days, you'd have to sit there with all those campaign gifts and build up that capital campaign number, even though you've already spent it. You're already building constructions, and you've spent all that money, but it's sitting there as a temp restricted number and just building up, and it looks like you're so strapped, right? When really you're not, because you've already spent that money. Now the new accounting guide is allowing you to release it as you incur it. So I'm excited about that. It makes the financials look a lot better.
And that will come up again here in our presentation. All right, allowance for uncollectible. So now you've done the job, right? You've received all these pledges, you've put them on your books, and now as the auditor, we get to look through and say, okay, well, great, they're all there. They exist. That's good. Now the next things we're going to hammer in on is valuation, right? If you've got it on the books for $1 million, is it really worth $1 million? Jason, I think the number one best practice that I like to see here is that the CFO, the head of school, and the director of advancement or development are talking on at least an annual basis. I really like to see it quarterly about valuation. Right? Because let's face it, you guys are working in your world. The head of school is out doing their thing with advancement. They're trying to raise money, but they know who's struggling. They know the payment schedules. You guys aren't really having those conversations. So we really like to see a best practice of a documented meeting, what was covered, who are the accounts that are being challenged, and things of that nature. I do have a story of a school that they had $450,000 outstanding. I think it was the new locker room. The kids were, I think, twins and they were juniors and not getting any payments, senior year, not getting any payments. They had to take their name down. Ugh. Big allowance for doubtful accounts, right? That's just not a good position for anyone. Go ahead.
Yeah, the big thing for us from an audit standpoint is making sure that we have documentation. So if we have a gift that's on the books and it hasn't made a payment in a year, 2 years, they're way off the payment schedule, knowing what's going on, right? That we've had the conversations and developments on the same page of, are they really going to make good, right? And then at that point, deciding whether or how much we do truly expect to receive in the future. I've seen a handful of my schools just create, a bit of a general reserve, and I know that goes against the accounting policies because you're supposed to know when those specific reserves are hitting, right? You create a little bit of a general reserve, or you look at your historical performance, right? Of the gifts you record in your books, we only write off 0.5%, right? So record the 0.5% as just a general, just to cover, hey, we may not know, right? There may be one gift that's sitting in our list of donors. Their life change, right? Their life changes and they can't fulfill it. So, but we've got a little bit of cushion and coverage there. That's usually what we see.
Jason, what about the family that, they're well-intended and they really want to do good for the school, and they give, a donation to the capital campaign, but they're also behind on tuition?
So watch.
Is that funny?
So you all laugh, right? But you have an auction, you have a gala, right? And the family's all, charged up and they want to support, and they come through and go, well, we'd like to contribute $25,000. On the development side comes through and goes, hey, we got a $25 written, everything's signed, right? We're good to go. And you go back and look at tuition, you go, well, wait, they're 3 months behind on the tuition, right? I'd argue you're not recording that pledge. Not until the tuition's caught up. I mean, you can hold it, right? Or you can book it and immediately reserve for it, which, why would you do it? But you can hold it until they make good on the tuition. I get the tuition first and then deal with the pledge.
Great. Question in the back. Hold on.
Dean, that last sentence is something I've been thinking about. You talked earlier about not recording a pledge, oral or otherwise, because you're just not comfortable with it. Do you, as the auditor, deem that to be different than recording the pledge with an immediately offsetting reserve?
What do you like to do there, Jason?
I'd rather not muddy up the balance sheet, right? And not have, the schedules and everything convoluted with pledges that you really don't think you're going to get. If it's a one-off and that's what everyone agrees is the best way to track it, fine. But I wouldn't put all those verbals on your books and then immediately put a reserve against all of them, right? It'd be too hard to track or figure out what's going on. So I'd hedge against it. If you have a fight for it and can make like a good practical decision on why this makes sense for you, then I can't fight you.
I think the big thing here is we do want to see everybody on the same page. Right, you and your head of school and your director of advancement. That is really what we want to see as the auditor, right? Because oh no, it's going to come, or oh they're changing their payment terms, or we're going to have one conversation with the director of advancement and one conversation with the head of school, and it's a different story. Ugh, that doesn't feel good, right? So we definitely want the transparency, and everybody being on the same page helps. Statement of activities, Jason. Anything that we need to point out here?
No, I think it's pretty straightforward. I mean, the allowance of the discount is going to net against your contribution revenue. So to the extent that you book all those verbals and write them off, when it flows through the statement of activities, it's going to be a net wash anyway, and it doesn't affect the revenue. So
great. Discounts or present value. We talked about this earlier. Any other thoughts on discounts, Jason?
No. The one thing that I have seen is that when you get the gift, in that year that you get the gift, that's when you set the discount rate, and that's what holds for the time period that gift's on the books, right? And then the next year, when you get a new set of gifts, they have a separate discount rate. The discount rate doesn't constantly move, right? Each year you don't reset the discount rate and then reset everybody's discount.
Materiality, I like it.
So the comment over here is materiality, right? And what's material, right? Technically, right? That's what you're supposed to do. I can't fight you if you just move it and it's moving by $10,000, right?
I will say this, I did have a school, and I feel so bad for this one because the CFO, she trained me, she helped me along for a long time, and she had that concept, and she had an error in her Excel file, and it turned into a material adjustment. And that was painful because we had a material AJE because it was just like, yeah, here's my file, and all of a sudden the Excel schedule didn't all the way work. So just double check that, right? Let's just make sure that we're all doing, moving forward, doing the right things. Hold on.
If you have a multi-year campaign, though, we were always told that each year if the interest rates are fluctuating, you would use a different interest rate for each year's pledges that you've received that year.
Correct. All right. So we are in Nashville, and if the capital campaign that you guys are embarking, that's going to be your hit song. Right. That's going to be what you and your head of school and your director of advancement, you're going to leave a mark on your school with what you're about to do. Right. Maybe now it's your second or third one, but this is all happening under your watch. And what we don't want is that hit song to be messed up with a big ouch, right? Somewhere in the middle of it. So these are the top 10 private school campaign reporting errors that we commonly see. We've talked about a lot of them, but we thought we'd give you guys some insight ahead of the curve. And so we'll walk through them again. But Jason, let's talk about number one was the implied time restrictions. We can circle back here. Go ahead.
Yeah, so that's the one where you received the pledge. You haven't met the time or cash payment yet. You've met the conditions, right? So if it's capital campaign, the building's in place, you just don't have it. You haven't met their payment schedule yet, so it's restricted until the cash actually comes in. Want to roll through?
No, yeah, let's do it. Releases. Anything else we want to put on number one on the implied time restriction there? Any questions there? Yeah. Hold on 1 second. Hold on.
So the donor has gifted $40,000, $10,000 over 4 years, and they give you all 40 up front out of the goodness of their heart. You have it written that it's $10,000 per year for the 4 years. Can you record it on the income statement as shown on that pledge form?
So what you would do in that case, so you'd record the full 40 in that first year, but then the 30,000 that's going to be released over the next 3 years would sit as temp restricted or with donor restriction, and then each year you'd release 10. So cash is in hand, but it sits as temp until you meet that 4-year period.
Even if it's unrestricted?
So if they pay you up front and it's just for operations, right, unrestricted, it's unrestricted. Yeah, there'd be no reason to have a payment. Like if they just decided, hey, you know what, we have the cash now, say year 2, right? They pay $10,000, then year 2 they get windfall cash or they get paid out for something or the stock market's screaming, right? They decided to pay the full 30, you can release the full 30.
Construction, CIP is construction in progress. Construction in progress temp releases.
So this is what I was talking about before, where under the current mantra, those capital campaign dollars for your construction, right, sit as temp restricted until the building is placed in service, and then you move it out to unrestricted. That's that whole, looks like you're upside down, but you're not really upside down while you're in this big campaign or your big construction phase. It feels like you're robbing from Peter to pay Paul, but you're really not. Under the new model and then the new guide, we can release as it's incurred. So as you're paying those construction bills and those heavy construction, GC payments are going out the door, you can release those temp restricted or capital campaign dollars you've already received.
When does that take effect?
Well, let's repeat. That's a very good question. When does the new FASB reporting standard take effect, Jason?
2019.
So depending on when your campaign is, where you are, that could have an effect on you. I will say that we went to a school, and this was 6 or 7 years ago, and they were in the middle, at the very tail end of a $50 million capital campaign. And the building wasn't done yet. It was almost done, like 95% done, but it wasn't placed in service. And we said, well, where are all the temp restricted net assets? And they said, oh, well, we've been building the building all along. And I said, okay, so you've released it all. They're like, yeah, $50 million. And their audit committee chair was the managing partner of KPMG. And he's like, so you're telling me I have a $50 million prior period adjustment? We're like, well, we should start talking about this. But that is where that's the story where this kind of came to light. Now, as Jason said, you guys are all planning for future capital campaigns where the accounting will be different. But if you're in one right now, we definitely want to see that asset placed in service before you do the release. We talked about, Jason, the long-lived assets for endowment.
So, and this is two parts. So part of it's that, but the other part is the way that it's presented on your statement of cash flows. We see a lot that the contributions for capital campaign or endowment aren't stripped out of operating and placed down into fundraising. So it really puts a big swing on your operating cash flows and the way that that's presented to the bank, right? In certain years, depending on the timing, right, it can make you look very cash flush from an operating standpoint, or it can make you really lean or even negative from a cash flows from operations, which the bank will come in and go, what's going on, right? And they won't be able to recognize the fact that all that fundraising and endowment gifts are all flowing through, or those pledges that you've received that have been booked, right, and are now stripping out of operating cash flow should really be fundraising activities down below.
Does that make sense? We really like to, if you think about it, unless you have drastic changes in your operations, your operating cash flow should be a pretty static number. Now, maybe you're adding students or something like that and you're expanding, but that's the consistency that people want to see when you're talking about the story of your financial statements and going out and having a capital campaign. Those are some of the things that we definitely like to see. We don't like to see why is cash flow from operations $7 million one year and $2 million the next, right? What's going on?
In our setting.
As a banker, we like to see a separate bank account, a couple of campaign projects for the cash flow.
And to repeat that for the recording, as a banker, our friend Kelly over here says that she likes to see a separate account, a separate bank account for those dollars. All right, here's another one, and we see this a lot. So you're going through the capital campaign, and the board, the advisory committee, they say, oh yeah, okay, we also want to set up an endowment for maintenance as well. That's going to be part of the $15, $20, $25 million that we're going to raise. And, 10% is going to go towards repairs and maintenance or some kind of, repairs and maintenance fund. Where's the challenge here, Jason?
The hard part is where does that 10% land, right? Is that the last 10%, right, that you fundraise and you may get there or you may not get there, or is it 10% across?
We're building the building first.
Right. So you're going to build it first, right? So are you stripping out 10% all along the way, or are you going to try and get that 10% as a kicker at the end, right? Just make sure it's very clear, and that more so than anything else, that the donor understands what they're giving to, and they're not selling them one thing and really doing something else behind closed doors, because that's, a fiduciary responsibility. You have to make sure that you're clear in how you're handling those endowment funds.
And again, this is a situation where everybody needs to be on the same page ahead of time, right? Let's make sure that the head of school and the director of advancement are all understand that this is what we're trying to do.
Well, we're just getting ready to embark on a really large capital campaign. We're talking about this very issue. We were talking about, being very upfront, telling donors we're going to reserve X%, whether we're not, 10, 15, whatever, of
Yeah.
every gift
Yeah.
And then if that's the case and they understand it, when you book the gift, it'd be 10% permanently restricted, 90% temp restricted? Is that how it would work?
Yeah. It just doesn't happen very often. The way you guys record things is very good at your school. Because I think most people will try to get that building done first.
Well, that's sort of a struggle, but
Right. No, that's the right thing to do, and to be very clear up front. Go ahead. Oh, question.
During a campaign, we may be...
Let me come over.
Sure. During a campaign, we may be fundraising for both like a building project and an endowment, and donors are very clear about which ones they want to support. Sometimes donors may say, we just want to give to the campaign, we don't care what you spend it on. At that point, do those gifts get counted as unrestricted then and get counted right there, or do we choose based upon what the school decides what it wants to go?
I like putting you on the spot, Jason.
No, that's great. I appreciate that. So I've seen it both ways. In the case where they say, hey, we're giving to the campaign and we don't care where it goes, a lot of times you'll put it in the bucket that you need it, right? So whether it's campaign, right? And you've already stipulated, hey, here's what the campaign is doing, right? So if you're short in a certain area, a lot of people will just put it in that area that you're short and say, hey, listen, thanks for contributing. This is where we need it right now. We're going to drop it in that bucket. And that's okay from our standpoint, too.
5, 6, and 7 kind of go together, and that's functional expenses, campaign costs, and master planning. Jason, give us some insight here.
So here's the hard part. So when you get into a campaign, obviously you're going to staff up. You're going to have more advancement people, right? Or a lot of times you do. You're doing more from a production, printing, touching, right? So you're spending more for the campaign. How do you account for that, right? And where does that sit? The one thing I'll tell you is that it can't be capitalized into the cost of the building. You're raising funds to build a building. You can budget for it, right? And it can be totally part of your budget, right? So your total budget of $20 million, part of that $20 million is the additional campaign costs going out to raise the money. What you can't do is then take that $20 million budget and lump that all into your future fixed asset. You can't capitalize those campaign costs. They still got to be expensed, which then impacts your functional expenses, right? So all of a sudden now, the years leading up to your campaign, you've already ramped up, right? You've hired additional, fundraising advancement folks. Your costs have gone up. So all of a sudden now you're spending 2%, 3% more in advancement than you were before, and your mix looks off, right? And everyone goes, why are you spending so much? And at that point, you're not receiving the dollars yet. You haven't received the fruits of that labor, right? That's coming year 2, year 3, right? At which point, then that cost, the cost to raise a dollar will drop way off. But until that point, all of a sudden that jumps up. Part 2 is that when you're going through the strategic planning process, right, and you're doing designs and you're getting architects and you're going through, hey, you got 3 different options on what you want to do with the future of this, multi-purpose gymnasium or the new wing off on the right-hand side. Well, you can't capitalize all those costs either, right? So you got to be very careful in what actually in the design process is stapled to the ground that you're actually going to use to design and build that building. The master planning, strategic planning, those costs to build out the strategic plan, unless it helps you get to an actual constructed building, it's just cost of the campaign, and it should be expensed.
What about if you hire somebody in development that's dedicated to the campaign? That's good. What if you hire somebody that's dedicated to the campaign and development? Can you capitalize that?
So when you hire somebody dedicated to the campaign in development, you can't capitalize it. It can be part of your budget, right? So when you say you create your campaign budget and you want to raise to $20 million, their costs and their salary should be part of your budget. And they should be factored into, hey, we need $18 million to build the building. We need $500,000 for design costs. We need another $500,000 for advancement just to raise the money to do this. It should be part of your budget. But you can't capitalize it on your balance sheet as part of the cost of building the building because they weren't swinging the hammer at the building to put the nails in, right? So you can't capitalize their time into it.
Oh boy.
So when you talk about master planning and you look at, I get this leads up to the bigger plan, but when you start talking about schematic drawings and the actual, plans that you submit to the city for permit, those type of things, and even the meetings that lead to those drawings, can those be capitalized?
It gets really gray. It's well, so let's look at this. So if it's a clean pathway, right, and you're not, the hard part is a lot of times there's like 2 roads we could take, right, and we're kind of dabbling on these 2 roads, and then finally we go, okay, we're going to take B, right, and we're going to stick to B. Whatever you incurred to go down A, right, should really be expensive because it has nothing to do with what your actual final plan was. Now, if you're going down this pathway and you got, hey, this is our one option, this is what we're doing, and we're going down the pathway, right? The permits, the design fees, everything that goes into actually being able to build that building can all be capitalized.
Follow-up question?
So in your example where we're raising 20 million, 18 million for the building and $500,000, whatever, to cover the additional fundraising costs, things, as you're actually paying those costs, how are you recording that on the balance sheet for those like additional people?
So they're being expensed.
They're being expensed?
So, yeah, you're going to expense them as it's incurred. It's just going to be your fundraising bucket is going to take a step up, and you're going to incur those additional expenses, but they should be fundraising their way out of. It's operating, yes, correct.
So I assume you can release, if you get advance gifts and these fundraising costs are part of the campaign, I assume you can release the restriction from those advance gifts to cover the cost of the fundraising.
Under the new guide, yeah. Under the new guide, yeah, for sure. It's all part of the campaign. It's all part of the cost of constructing the building, right? So you had to pay for additional resources to raise the money. So you can release it as part of that total $20 million budget. You'll release those capital campaign gifts. Not currently. You could early adopt, and I bet, for those of you that don't work with us, I bet the auditor would probably go along with you if you said, hey, listen, the guy's going to change in 2 years anyway, right? We're just 1 year out in front of it. This is what we want to do, and it makes our balance sheet look better. I'd be hard-pressed that they're going to fight you real hard on that.
Construction payables, Jason.
So construction payables. So here's the hard part. So you're in the middle of the campaign, you're getting to the end of the year, right? And it comes up, I'm assuming most everyone in the room's June 30. So we're going to use that. So you get to June 30. The contractors and GCs are notoriously slow at getting you bills, right? And getting you progress bills because they're waiting for their subs, right? They got to wait for their subs to submit their contract, their progress work orders, to get then to a consolidated one that they ship to you. It could be 45 days, right? You could be, a month and a half later before you actually get a June 30 work in progress bill. What we found is that a lot of times it's not recorded, right? So you got to make sure that you go back and you wait until you actually get that 6/30 progress bill and record that progress bill. And that's going to roll right into part 2, is that in most of these construction deals, and you should have this for your protection, there should be a retention, right? Where the GC is retaining or holding back from billing you 10%. And what that 10% is that when you get to the end of the contract, you get to the end of the construction, right? And you have all these small, it's a punch list, right? You make sure they go through the punch list of fixing those small items, right? And you don't release that 10% holdback until they've checked the box and finished those punch items, right? That punch list has to be signed off and complete. That means they fulfill the contract. Along the way, they're going to hold back on that 10%. You need to book that 10%, right? You should have the payable sitting there, right? And gross it up. So capture the full work in progress through 6/30, including the 10%, and roll that up into your construction in progress on the balance sheet.
Yes.
Should there be
I'll repeat. The question is should there be a separate construction payable and a separate retention payable?
I'm not definitive on whether you have to have 2, but I would definitely say that you got to break out construction payables and retention from your general AP. Don't lodge it within your total AP. Break it out and call it out separately. But if you want to commingle and say construction and retention payable, right, as one line item, that's fine.
And lastly is the parent. Oh, go ahead.
Have you run into, with your bank, in ratios that you're under with existing loans, and with expensing versus capitalizing or restricted assets during the period of construction? Have you run into problems with the banks as far as liquidity ratios or debt service coverage ratios or anything like that?
Yeah. Yeah, I think we got to manage those very tightly. You know, this whole process, you definitely want to be as strategic as possible throughout. And I again, transparency, work with your bank. Let them know this is where you are, this is how things are going, this is what my draws are looking like, this is what my collections on my pledges are looking like, this is what cash flow looks like, all of those things.
A lot of times what we try to tell our existing clients is try to push that out until you get to the end, right? Where you get to the full draw. Because at any given time, right, in the interim, at year end, you may have paid for the stuff yourself and not pulled the draw, or you pulled the draw earlier and all of a sudden you look really liquid, right? But you got all these payables coming down the pipe in the next 4 months, right? So in the interim, in that, maybe 1 year, 2 year at the fiscal year end, as long as you're having a dialogue with the bank to make sure they understand where you're at, right? And this is why the numbers look so funny right now, you should be fine.
Okay, last one, Parents Association, our favorite.
So this one's awesome because a lot of times your Parents Association is very much involved. You're in a campaign and they want to help, right? So they're out there, banging the drum, trying to raise money and raise funds. What we found is that a lot of times the Parents Association isn't a separate 501c3. So they're not on your books, right? So if they're not a individual organization that stands alone, those bank accounts that the parent association has are your accounts. Those are your bank accounts, not theirs. So you need to draw that stuff back and bring it back in. And usually it becomes very apparent when all of a sudden they're doing campaign fundraising, they're getting bigger dollar amounts, right? And all of a sudden we find out that there's, 2 bank accounts in the school's name that aren't on our financial statements.
Completeness. We always like to look for completeness. Any questions? Go ahead.
I have 2 questions, actually.
Oh, here, let me give you the mic then.
So for my first question on the implied time restrictions, so if you have a pledge that someone doesn't make a payment on for 10 years, they were supposed to, but they haven't. Or maybe they had a 10-year pledge, who knows? The building was built 10 years ago. We get the final payment in, we release it right away. Because the building's done, they made the pledge for that particular, what are you looking for as evidence as to having fulfilled that other side of the pledge and spending that money? Do you care?
So at that rate, we don't care.
If it's $1 million, do you care?
So it's $1 million, it's still in your, what's that? So the issue there is that it's $1 million and it's still sitting there as not received, right? So it hasn't been released, but you went ahead and built the building anyway. So you covered it through operations.
Right.
To the
Are
extent
you
that you don't.
looking for evidence of expending it through operations at that point?
No, because there's no fiduciary responsibility to anybody. It's unrestricted funds that you guys elected just to cover the difference, right? So there's no problem there. It's still sitting as a restricted gift.
Okay. On the releases while you're doing construction, so if you have unrestricted capital gifts and you're building the building, can you release the unrestricted capital gifts as you're building it, but then say if there's specific, athletic center gifts, that you can't release it until the athletic center is done?
So let me understand this. So if you have unrestricted gifts, that's really what you're talking about. It's like a board. The board has set aside funds. Because if it's unrestricted, then there's no other bucket to move it through, right? So
Unrestricted capital gifts.
it's campaign gifts, but they're just for.
That was an oxymoron.
Okay, yeah, sorry. I was like, I got confused. So as you complete it, yeah, then you can release it, right? As part of that campaign is done.
But if it's unrestricted capital, that sounds funny to me, though.
It's unrestricted. No, it's capital campaign that doesn't have a designed purpose, right?
Oh.
So part of the campaign, you have, hey, just general campaign gifts, and then here's the pool, and here's the MP, and here's the gym, right? So these pieces are spoken for, but this part's just, hey, campaign gifts wherever you need them, right? So if you do some other side project, like you're building a gym, you decide to design out, some outside eating area, right? As part of the campaign, you just go, okay, we have these unrestricted gifts. You release them as you complete that portion of the campaign.
Do you guys have any experience? So you have a $500,000 pledge. The first year comes in $100,000 and it's coming from a DAF. Donor advised fund, I'm sorry, which means do you reverse the pledge, but then you're giving contractual relief, which is the issue with the donor advised fund.
Yeah.
I agree. So do you back out the next 4
Right.
years?
Yeah.
Yeah.
You got to remove it, unfortunately.
One received, yeah.
Yep.
Okay.
Because they could the problem with the donor advised fund is that they can redesignate, right? They could change their mind and redesignate it to go somewhere else. So that's why you can't record the full amount up front.
So you could go back and remove the 400, which they could pay with.
They could, right? They could.
So you would take that.
So we'd have to have a long conversation about that. But yeah, we could take that argument and go, hey, listen, they fulfilled, or some way that we could show some sort of historical performance and go, okay, we could probably just leave it, right? We know they're going to make good on it. They've said they're going to make good on it, whether it comes from the donor advised fund or not, right? They've somehow stipulated that they're going to make good on it, and we feel very comfortable about it. Maybe we just leave it.
So sort of two parts to this question. First part, with regards, but it's also a follow-up to donor advised funds. For your clients, are you adding any extra disclosure, like perhaps not recording it on the balance sheet, but within the footnotes, adding a disclosure that might show the receivables that are donor advised funds? Are you guys commonly doing that? And then secondly, with some of the implications of the tax changes, do you see donor advised funds becoming more and more and more of a concern or things that we have to address?
Sure. Part. So I'm okay putting in the footnotes. I'm not saying you have to. If you want to display a position that you look a little more solvent, yeah, right. If you're trying to promote that, then yeah, I have no problem with you putting in there and saying, hey, we got this donor advised fund and these gifts coming, and this is what
Same thing for oral
schedule looks like.
Same thing for oral pledges as well.
We could put it in there. It just wouldn't be on the balance sheet.
Right, and then with regards to the tax implications, we're still looking at all of that. So with that said, I think, what time are we at? We are at 11:37. We're getting really close to any more questions. If not, what I would like to, here, I think we got one last. Go ahead.
In terms of in-kind donations.
Here, let me give you this.
In terms of in-kind donations in a campaign, what are you all looking for in terms of valuing those in-kind donations? So we've had quite a few of that in the last campaign that we had, and it's just really, okay, here's how much we're giving you. Great, and that's what we've gone with, based off of what they've said,
Yeah, to the extent that we can. I mean, if it's smaller amounts, right?
Steel, $570,000.
Whoa.
I'd price it in the market, right? Figure out what you would have paid for it, right? If you had to pay for it outside of your agreement, and figure out what that dollar amount is and line it up with the two, right? And you go, okay, yeah, record it at that, right? And then obviously capitalize the other side. But yeah, wow, I haven't seen that before. That's a great gift.
That's like our school that got the $15,000 Snapchat investment. Yeah, Jason had to value all of that stock before it went public. But yeah, I don't know how they're ever going to get a tuition increase again when 15 grand turns into 40 million, but hey, so be it. All right, with that said, that is the end of our presentation. We do want to touch on a couple things. If you have any questions, please come up to us after. We have business cards up here. We also have Starbucks gift cards. If you show us that you like us on Facebook, we'll give you a Starbucks card. And then we also have our 4th annual NBOA nightcap tomorrow night. We have flyers for that. So at the end of the day, everyone have a good time in our throw up to Nashville. Thank you very much.